Alrighty, we got enough, and let's start right away. And welcome. Hope you're having a wonderful weekend. This session is all about position sizing and position management. We're going to go over what it means and how it can be a lifesaver, especially if you're trading with the smaller accounts, or it doesn't matter what size account you're trading with. Not understanding what these two means can have a devastating impact on your P&L in the long run. Risk management doesn't exist without position sizing and position management. Those two go hand in hand with each other. That's what we're going to talk about in this session. So all you need for this session is a notepad and a pen. You don't need to have any charts open. You don't need to have any of these screening softwares open. You don't need any of those. As long as you have a notepad, as long as you have a pen, you can follow along. So we do have some exercises for you guys so that we can work on it together so that you have a solid understanding of the concept which we're going to talk about. That is going to help you out to understand the same even better. So this session is recorded. So even if you find difficult in grasping the concept right now during these sessions, you can always go back, replay the same, and I will share the Excel sheet alongside with it, where like you just have to put in your entry price and the stop price. It's going to give you the position sizing, whatever sizing you need to take for your account size as a result. So with that being said, let's get things started. First things first, the agenda is pretty simple. We're gonna go over what position sizing means, and then we're gonna give some few examples of a bad sizing and a good sizing. And then I'm gonna give you guys a few exercises for you guys to work on it. And the same for position management. We're gonna go over the basics, and then we're gonna go over the exercises. And then we're going to talk about how, if you have like a larger portfolio, how to manage multiple positions. If you have like 5 positions open, how to allocate risk for each and every one of them. That's what we're going to talk about into this session, and let's get started with position sizing. So when it comes to position sizing, the common understanding for people is like, let's say you're trading with $1,000 account, position sizing is like, let's say like I put in $500 in one stock, $500 in another stock. I'm not putting all my money into one stock. I'm separating it so that I have money to buy the dips, and that is what position sizing means, when in reality, that has nothing to do with position sizing. Position sizing is not about how much money you're putting into one particular play on where you're averaging up. That's not what position sizing means. That is scaling. Scaling is absolutely different as to the position sizing, and we will go over it in detail. And there is a famous quote: foundation of success is built on solid risk management. And risk management doesn't exist without position sizing and position management. And don't get confused with the term position sizing to that of the scaling, because it's very easy to do so. So with that being said, position sizing is nothing but calculating the amount of capital allocated per trade in regards to the risk versus the broader portfolio. So how much you're risking versus your broader portfolio matters way more than how much your initial investment is. So when we go over the example, it's going to make more sense. So take out your notepad and pen and take the scenario down. First things first, let's say in this scenario, you're trading with a $2,000 account. That's all it is. $2,000 account is what you're starting to trade with. And you can have a lower priced account, doesn't matter. But for now, we're going to stick with $2,000 in this hypothetical example. The first question you need to ask yourself, regardless of what size account you're trading, you can be trading with a $50,000 account or $1,000,000 account or like a $500, $600 account, doesn't really matter. First thing you need to calculate, what is 2% of your overall account size? It doesn't matter. You can have like 10 accounts opened in multiple brokerages. If you're opening a position in a particular account, what is 2% of that account is? Calculate it and then write it down separately. That's what we call as risk tolerance. Some people, for me, I've found 2% working out really great. You might be having 3% risk tolerance or 4% risk tolerance. But again, don't have a risk tolerance of 10% of your overall portfolio for each trade, because maximum you can be wrong is just 10 trades. All it takes is 10 bad trades for you to blow up your accounts. Don't put yourself in that position. 2% is the sweet spot. And you can go with 1.5%. I know traders who only risk 1% per trade. Again, 2% is a sweet spot. I'm going to stick with it. But again, don't go higher than 4% and don't go lower than 0.5%. That's all I can say. So stay in that sweet spot between like 0.5 to 4%. And this is in accordance to your overall portfolio. So let's say 2% of your portfolio is like $60. 2% of your portfolio is, let's say, like $10, $20. Doesn't really matter. In this example, we're going to go with a $2,000 account. 2% of a $2,000 account is $40. So write it down separately. So let's say there is a stock trading at $10 each, and you're looking at the charts and you like the charts and you're setting your stop losses at $9, which means if a stock price falls from $10 to $9, you're going to get kicked out of your positions. And now the total shares you're purchasing here is, let's assume 100, because you're trading with a $2,000 account. And if you put in like 100 shares, you'll be spending like what, $1,000. You can actually purchase 100 shares with this account, by the way. And how much money will you lose if you get stopped out? So your entry is $10. Your stop loss is at $9. You're buying 100 shares. And if you get kicked out, the amount of money which you will lose is $100. But again, if you think about it, your total risk tolerance is just 40. But here you're losing $100, which is 5% of your account. But our risk tolerance is only 2%. How can you limit this? How can you reduce this risk tolerance? By reducing the number of shares which you purchased. Initially, it's a borderline example of just because you can doesn't mean you should. So your entry price is 10, stop loss is 9, and you can purchase 100 shares. But if you do, and if you do get stopped out, you're going to lose $100 in this trade, which is total risk of 5% of your entire account. Not worth it, because it goes against your rule, it goes against your risk tolerance. If you notice something, we're not talking about the amount of money which you're putting in to buy these shares. We're talking about how much you will lose if you get stopped out on these shares. Big difference. It's easy to get confused about. When I say don't risk more than 2%, the confusion is, are you just saying I should only put in $40 to buy a single contract or buy a single share? No. You can buy as much as you want. You can just put in your entire portfolio into a trade, into one trade. But what we're talking about is how much you will lose if you get stopped out. That money shouldn't be more than 2% of your entire account. And this is an example of a bad position sizing. You just entered with no regards to how much you're going to lose, with the potential of, I'm pretty sure like the entry is pretty good, so I'm just going to buy 100 shares here and I might make XYZ amount of money, but that doesn't really matter how much you will lose, because if you get stopped out, you're going to lose almost $100, which is 5% of your entire account, which goes against your rule of 2%. What is a proper sizing looks like? Proper sizing looks something like this. Same scenario, same entry, same stops, but instead of buying 100 shares, you're going with 40 shares. So let's say you get stopped out on this trade. 40 shares, for each share you lose, you're going to lose $1 on each. So if you get stopped out, you're going to lose $1 in each shares. And if it drops $1 from your entry, you're going to lose $40, and thus put your overall size to 2% of your account. Even if you get stopped, you're only going to lose 2% of your entire account, which goes with your risk tolerance. So the first things I want you to do is take your notepad and write down what 2% of your account is. So if you're trading with a $5,000 account, 2% is $100. If you're trading with a $10,000 account, 2% is somewhere around like $200. So write down what's 2% of your account in your portfolio which you're trading with is. It doesn't matter what your portfolio size is. Try to calculate it. Try to calculate what 2% is. Write it down. That'll be your risk tolerance. If you're going to risk 3%, write down what 3% of your portfolio is, but no more than 3 to 3.5, at maximum 4. If you're a beginner trader, I wouldn't risk more than 1.5% in a trade, by the way. But if you are opening multiple positions, we'll go over how to allocate the risk accordingly. But for now, stick to 2%. Write down what 2% of your portfolio is in a separate sheet of paper and leave it aside. It's going to come in handy when you're doing your exercises down the road. All right. So now this is an example of proper sizing. Even if you get stopped out, you won't lose more than 2% of your account, unlike what you did right here. You can buy 100 shares on this, so you just bought it without no regards of like, oh, if I lost, how much I will lose, like how much percentage of my account will take a hit. And you did lose, and you did lose 5% of your portfolio. And in this scenario, your bad entry isn't your problem. Your problem is bad position sizing. So you'll see this common bad analysis, bad self-analysis from the new traders where like they lose money and they automatically attribute it towards bad entries. Bad entries has nothing to do with you losing 20, 30% of your portfolio. You don't know if an entry is good. You don't know if an entry is bad until after the fact. Do you agree? Because you don't know what the market is going to do the next second. So how do you know if your entry is good or your entry is bad until after the fact? You don't know that. When you enter a trade, you think that's a good entry. That's why you bought it there in the first place. But then after you bought it, it didn't go in your favor. You lose a bunch of money. Bad entry shouldn't drop your portfolio like 20%. That's not bad entry. That's bad sizing. That's bad position management. Write down the 2% and we'll move on to the next example. And I'm going to teach you how to calculate this on your own. Right now, I just put in 40 shares. How did I get to this 40 shares? How did I get to this like 40 shares in value? Like what's the sweet spot? How did we get to this number? We're going to talk about it in detail down the road. So let's go over another example of a bad sizing and a good sizing. Now in this scenario, we are trading with a $5,000 account. 2% of this account is $100. And there's a stock which is trading at $55. You're setting your stop losses at $53. And initially, let's say you're buying 90 shares on this trade. And let's say you bought it and you got a terrible entry and you got stopped out and you just lost like $181 instantly. $181 gone. Now, with this, you just lost 3.8% of your entire portfolio, which is way more than our risk tolerance, which is 2%. This is an example of bad sizing. At this point, it doesn't really matter if it's a great setup, if it's a bad setup, if it worked out perfectly fine, you would have made XYZ amount of money. It doesn't really matter because you purchased 90 shares, it didn't work in your favor, you lost $181, which is 3.8% of your entire account, which is way more than the 2% risk level which we set. How is the proper sizing looks like? How can you limit this 3.8% loss? You can reduce the number of shares which you purchased. So how about you buy 50 shares instead? When you buy 50 shares, your overall risk drops to $100, which is 2% of your entire account. So before opening a position, start with how much I will lose if this trade didn't go in my favor. We're doing a reverse engineering here. We're not doing if it works in my favor, I will make like $10,000 or I will make like 7% of my account. It doesn't really matter how much you will make if it works in your favor. You don't know that. The only thing that you do know is if you are wrong, how much you're going to lose. We're going to start building from there. That's the first question which you should be asking. You know your entry price, you know your stop price. If you do get stopped out, how much you will lose. Let's say you do your calculations and it comes out to like 5% of your entire portfolio. You have no business in taking that position regardless of how good the upside target looks. Reduce the number of shares which you're buying. So when you reduce the number of shares which you buy, or reduce the number of contracts if you're trading with options, if you're reducing the number of contracts which you buy, you're bringing down your risk level to 2%. And once that 2% is hit, that's the amount of shares which you're going to go with. You're going to see how big of an improvement your psychological aspect gets when you stick to this risk level. And I'm pretty sure if you are a type of trader who can't take the eyes away from the screens when you're in a position, looking at the 1 minute chart and panicking for every green candle and every red candle which you see, you're in a type of situation right now because of the bad sizing and bad position management. Because if that trade goes against you, you're just going to lose like weeks or months worth of progress which you made. That is not an entry problem. That is a sizing problem, as mentioned before. So try sizing your positions in a way like you're only going to lose 2% of your entire portfolio. You're going to see, you're just going to open the position, you're going to set your stop losses, and you're going to walk away. You're not going to keep staring at it every single minute because you exactly know how much you're going to lose if you're wrong. So now let's go over how to calculate this number, this 50 shares. How did we get to this 50 shares number? That's the important part, right? You know the 2% of your account and you know your entry, you know your stops, and now how to calculate the exact number of shares which to buy. That's what we're going to talk about next. So it's pretty simple. This is the template and we're going to start from the get-go. So let's say you have your entry price at $55. Let's say you have your stop price at $53 on the stock price, which you see. Now, write down this template. Risk equals entry price minus your stop price. In this scenario, the entry price is $55. Your stop price is $53. And your total risk is 55 minus 53, which is $2, which means you enter at $55. And if the stock price drops $2 from your entry, you're going to get kicked out. So now let's say, do you remember the 2% of your account which you calculated before? In this scenario, we're going to go with $5,000. 2% of this $5,000 account is $100. So in order to calculate the proper number of shares which you should be buying, divide this 2% of your account by that risk, which is $2. In this scenario, 100, 2% of your account divided by 2. And you're going to be getting 50. That's the maximum amount of shares which you should be buying. It can be 45, no worries. It can be 30, no worries. It can be 25, no worries, but no more than 50. 50 is the maximum you should be going for. And how did we calculate this? Pretty simple. Take the value of 2% of your account and divide that with the risk. Risk is nothing but your entry price minus your stop price. And that is going to give you exactly how maximum amount of shares which you should be buying if you've gotten stopped out. Now go back to the example and see if you can find it. The first example, what is the risk here? Entry price is 10, stop price is 9, risk is $1. So if the stock price drops $1 from your entry, you're going to get kicked out. What is 2% of your account? 2% of your account is $40. So now how many shares you can potentially buy? 40, 2% of your account divided by the risk, which is 1. Total shares, 40. This is the maximum amount of shares you're allowed to purchase in order to stay within your risk tolerance of $40. So this is as easy as it gets. This is how you calculate your proper sizing. So 2% of your account divided by your risk. Risk is calculated by subtracting the entry price minus your stop price. So I'm going to stop it right here. So let me know until this point. If you guys have any questions, you can just reach out in the Zoom. You can just ask right there. And we're going to start with the exercises. It's going to make even more sense down the line. So for now, note down this: risk equals entry price minus stop price and 2% of your portfolio calculated. So if you want to calculate the total number of shares, pretty simple. Risk tolerance, which is 2% of your account, divided by your risk on that particular trade, which is going to give you the maximum amount of shares which you should be buying with your portfolio for this particular trade. So if you guys don't have any question, does this change if I'm doing leap contract? The risk stays exactly the same. Doesn't matter what instruments are you using, by the way. It doesn't matter if you're using options to trade. If you're using options, I'm using the entry price at 10, stop price at 9, right? Let's say tomorrow the market opens and you're trading the same with the options. Let's say you buy like 6 months out call option and you're spending somewhere around a ballpark of $1,500 on the trade. So your entry price will be at 1,500. And let's say you're putting a $300 stop on that. So your stop losses will be at 1,200. And what's going to be the total risk? If you're going with this stop, what is going to be your total risk? Risk is going to be entry price minus stop price, which will be $300. We're talking in terms of options, by the way. So $300 is going to be your total risk. So this cannot go well with this account, because how can you enter any contract if 2% of your account is just $40? Because even if you get stopped out, you can't size your positions properly at all. Even if you buy one contract with this, you're going to lose almost like 15% of your entire account if you've gotten stopped out. This scenario, this is why position sizing plays a major role. And this is one of the main reasons why I say if you have an account size of 7,500 and under, it is very difficult for you to trade any options with a decent size stop. Because you can exactly see why. Because 2% of your account is just $40. Even if you put it at 4%, it is $80. And if you lose in this one contract, and if you get stopped out in this one contract, you're losing $300, which is 15% of this entire account. At this point, it doesn't really matter if this $300 is the money which you can afford to lose. Your goal is to grow your portfolio. So you've got to look at things from the eyes of your portfolio instead. You can't look at it from the eyes of, I can afford to lose this or I can afford to lose that. If you're having that mentality, it's going to be very difficult for you to grow the portfolio which you're trading with at the moment. So now this is how you size it. Take your premiums, take your stops, calculate the risk. If that risk is way more than $40, 2% of your entire account, you have no business in taking that option trade in the first place. It doesn't matter if it's a leap option. It doesn't matter if it's zero DTEs. It doesn't matter if it's like a weekly options. It doesn't really matter. Know the entry price of your options, know the stop price of your options, and calculate the risk. Risk is nothing but entry price minus stop price, and then compare that risk with 2% of your account. If that risk is less than 2%, you can add more options contract. How much contracts you can add? Pretty simple. Risk tolerance divided by the risk. You're going to get you the amount of contracts which you can buy on that same trade. If the risk is more than 2%, you have no business in taking that trade in the first place. Got it. Look for a different trade which doesn't expose you to a lot of this 15% of risk. So something to keep in mind. I was way wrong with my position sizes. I blew up my account 3 times already. Exactly. So if you don't have a proper understanding of this fundamentals right here, that 3 is going to turn into like 6 or 7. So something to keep in mind. It's not the entry strategies which you're doing, which is blowing up your account. It's not your technical analysis, which is bad technical analysis, which is blowing up your account. It's a bad position sizing, and it's a bad position management at the end of the day. Something to keep in mind. Can you discuss the calculation of average ATRs of the stock? We're not going to discuss that in this meeting. We're not going to talk about ATRs in this meeting on how to calculate the stop price or entry price. We're going to have a separate technical analysis class where we're going to talk about how did we get to this entry price? How did we get to the stop price? This session is mostly on you already have this entry and stop pre-existing and how to size your positions properly. That is what this class is about. And the next class, we're going to talk about how did we get to the stop price? How did we get to this entry price? And with the point is, if you don't understand this part doesn't even matter. So how did you get your entry price? How did you get your stop price? Doesn't really matter if you don't know how to execute the same properly, how to size the same properly. So hope this makes sense so far. So with that being said, we're going to start with whatever questions you have. We're going to start with the exercises. And once you do the exercise, it's going to make more sense. You did give us some samples on this earlier. How did the answers turn? I don't get it. I don't understand. Can you explain the proper sizing on this page again? Not clear. If the risk is 300, how did you stop at 40? Exactly. You cannot, Tammy. That's the point. Your risk, with the stop loss, you cannot take this trade at all. Even with one contract, you're going to lose 15% of your portfolio with the stop losses. Not worth it. So you cannot take this trade in the first place because 2% of your account is just $40. If you just take this trade, you're going to lose 300 if you're wrong, which put this trade right in the garbage bin. It's not worth taking it in the first place sort of scenario. All right. So now let's go over some exercises and see if you have any struggles calculating the same. So in this scenario, we are dealing with a $10,000 portfolio. All right. $10,000 portfolio. 2% of this $10,000 portfolio is $200. All right. So your entry price on a stock is $317. Your stop price is $310. What is the total risk? What is the maximum amount of shares you're allowed to buy within this risk tolerance? And what's the right number of shares you can buy with proper position sizing? So now, here's all some ins. In order to calculate the total risk, take this entry price and subtract it with the stop price. And that's going to give you the answer to the total risk. Now, how can you calculate the maximum amount of shares? 2% of your account and divided by total risk. And you're going to get the maximum amount of shares which you can buy with this portfolio. You're going to run into a peculiar hurdle here. Once you calculate this, let me know if you can figure it out. I'm going to give you guys 30 seconds to calculate this. Go ahead. Let me know if you can find it. You have your entry price, you have your stop price. In order to calculate your total risk, it's entry price minus the stop price. So subtract these two numbers, you're going to get how much you're risking. You're going to get answer to this. So in order to calculate the maximum number of shares which you're allowed to buy in this portfolio, pretty simple. Take this 2% trade and divide it with the total risk. You're going to get the maximum number of shares which you can buy. But after doing that, you're going to run into a peculiar hurdle here. Let me know if you can identify the hurdle. Right, so we're getting some answers already. We're going to give it like 30 more seconds. Round it off. If you're getting a fractional result, round it off. Round it off to the recent whole number. This is Landon. Welcome, Landon. 28 shares in total, 28 shares. Beautiful, beautiful. We're getting the answers. If you're struggling, let me know where. Write down where you're struggling in the first place. It's pretty simple mathematical equation. So write down the formula and just plug the numbers in there. Total risk is nothing but your entry price minus your stop price. That's going to give you a total risk. Maximum shares allowed to buy. Pretty simple. 2% of your account is $200. Divide that by the total risk, which is 7. 28 shares in total. We're risking too much with the max, right? Not necessarily. Not necessarily. Again, that's what I said. The amount of initial investment doesn't matter. Right now, your initial investment with this 28 shares is $8,876. So $8,876 is what you're putting in for 28 shares. How much you put in doesn't matter at the end of the day. That is your initial investment. The only thing which we care about is how much you're going to lose if the stock price drops $7 from your entry. So if you buy 28 shares and if it drops $7 from your entry, you're not going to lose more than 2% of your entire account. The loss will be less than $200. So the right amount of shares is 28. 28, good, really good with math. Good job, man. I can see that. This is 28, 28, 28. So did you guys get 28 as an answer? If you did, good job. If you didn't, well, when we go with the answer, we're going to explain the same properly. Try to get it next time in the next exercise, whatever we got. So now let's go over the answer. The entry price, 317. Stop price, 310. And the total risk is entry price minus stop price, which is 7. If you got 7, you got it right. Good job. And the next one is the maximum amount of shares allowed to buy is risk tolerance, which is $200 divided by 7. We're putting it 28 here. It's going to be a fractional result. It's going to be 28 point something. Round it off, you're going to get 28. That is the right number of answers, right number of shares. So how much money you will lose if you get stopped out? In order to calculate it, it's pretty simple. 28 shares, if it drops like $7 from your entry, you're going to lose $196, which is less than 2% of your entire account. So hope this makes sense. So how did I get to this 196? It's pretty simple. You're just calculating if after buying 28 shares, if the stock price drops like $7 from your entry, in order to calculate how much you're going to lose, just multiply the amount of shares which you bought with your total risk. You're going to get the amount of money which you will lose if you're wrong. And you'll get $196, which is less than 2% of your entire portfolio. And that is the proper sizing you have to go with. Hope this made sense. So we're going to go with another exercise, and that is going to clear things up even better. I got 30, Chris, you're wrong. So try doing this other exercise and see if it makes sense. If not, reach out to me in DMs on where you're wrong, and we'll go over it. We'll go over it in detail. So the next exercise. In this case, you're dealing with a $7,500 portfolio. 2% of this portfolio is $150. So your entry price is $155. Your stop price is $153.30. So the maximum amount of shares you're allowed to buy, calculated. This is going to be a bit tricky, and you'll see why. Okay, 88. All right, Landon, I have a question for you. What's the account size you're trading with in this? 7,500. So the stock price is 155. Can you afford to buy 88 shares with this account? You only have 7,500 to deal with. So you said 88 shares with a $155 entry price. You should be having $13,640 to make that decision. That's the tricky part here. Try to figure it out. What's the maximum amount of shares that you can buy, but what's the right amount of shares? No, you need 13,200. Exactly. Do you have 13,200? No, you only have 7,500 in your portfolio. So now try to correct it. See if you can get to an answer. I'm going to give you guys a minute. 100 shares. Interesting. You don't have, how do you get to the 100 shares, Stokes? Go ahead, give me the answer. It's pretty simple. Same template, but we're going to tweak it a little bit here. Entry price minus stop price will give you the total risk. In this scenario, what's the total risk? Calculate it. Total risk is $1.70. That's going to be the total risk on this. So now what's the maximum amount of shares you can buy? So it's pretty simple. 150, the 2% of the risk divided by your risk tolerance. You're going to get 88.23. You can round it up to 88. But here's where the trick comes by. 88, correct. But again, what's your account size here? Your account's like if you buy 88 shares, you won't be having enough money to buy 88 shares in the first place. If you buy 88 shares, you need $13,640 in your portfolio to buy 88 shares. You don't have 13,640, you only have 7,500. How are you going to solve this? You guys understand the problem here, right? The answer is 88 shares if you just follow the template. You get 88 if you just follow the template. That's the right amount of sizing. That's the maximum. But exactly, not enough capital. How can you solve this? How can you solve the scenario? What is the maximum amount of shares you can buy with this account, by the way, with your 155 entry? Decrease the amount of shares. You cannot afford 75 shares. You cannot afford 50 shares. It's pretty simple. All right, in order to calculate it, take your account size, which is 7,500. Divide that account size by your entry price. Maximum is 48. Beautiful. You don't buy those shares. Not necessarily. You don't buy 88 shares. So in order to calculate the maximum amount of shares which you can buy, it's 7,500 divided by your entry price. That's the maximum amount of shares which you can buy, which is 48. In this case is pretty peculiar because you can buy 40 shares, you can buy 30 shares. With this stop losses, you cannot buy more than 88 shares. That's the risk. Anything under 88 is a go. You got your maximum amount of shares which you can buy, which you should be buying, which is 88, following the template. But you don't have enough capital to go ahead and do so. So now 48 is the maximum amount of shares which you can buy with your buying power, with your account size. Now, even if you put in your entire portfolio in this trade, your risk, now, if you buy 48 shares, what's the risk? Calculate it. Now, you're only buying 48 shares. How much money will you lose if you get stopped out on this trade? You cannot buy 88. Now you're buying 48 shares. If you do get stopped out, how much will you lose? Just multiply that 48 by 1.70. You're going to get your answer. 81.60. Beautiful. So 81.60. Great. And now for people who don't get this, it's pretty simple. 48 shares is the maximum shares which we can buy because you're only trading with a $7,500 portfolio. So now, in order to get the maximum amount of shares, it's 7,500 divided by 155, which will give us 48 shares. So in order to get the amount of money which you will lose with this 48 shares, it's 48 multiplied by 1.70, which is your risk, which gives you $81.60. Now, is this $81.60 greater than or less than 2% of our portfolio? It is less than 2% of our portfolio. And does this mean you have a proper sizing on? And one thing to understand, you put in the entire portfolio in this trade. But again, it doesn't really matter. What matters is how much you're going to lose if you get it wrong, if you get stopped out, if your stops get hit, how much you're going to lose. That's what matters. So if your stops get hit in this scenario, you're losing $81 in change, which is less than 2% of your portfolio. And that is a go. So I hope this made sense. So I wanted to give this example because it has the trickiness to it, which we just went over right now. So hope it made sense, by the way. Hope it made sense. And if you guys have any questions, let me know. So right now, here we put 45 or anything under 88 is a go. So I just put in 45 in here. 48 is a good answer as well. 48 is a good answer. 45, 46, 20, 25 doesn't really matter. So the total risk for anyone who didn't get it, let me go over it again. So the total risk is calculated by subtracting your entry price minus your stop price, which is 155 minus 153.30, which is $1.70. That is your total risk. So the next rule is maximum shares allowed to buy. The maximum shares allowed to buy is 2% of your entire account, which is pretty simple. 2% is 150. Divide that 150 by this 1.70, you're going to get 88. But again, the problem here is you don't have enough capital to buy 88 shares because you're entering at 155. If you want to buy 88 shares, you need to have at least $13,000 in your buying power, which you don't. So now how are you going to fix this issue? You're going to fix this issue by looking at it from this way. The maximum I can buy is 88 shares, but I cannot buy 88 shares because I don't have enough capital. But now, anything under 88, it's going to risk me less than 2% of my account. So now the maximum amount of shares you can buy is 48 shares in your buying power. 7,500 divided by 158.5 is going to give you 48 shares, which is the maximum amount of shares that you can buy with your buying power. You can just go ahead and do so. 48 shares will be the proper sizing with this example. And anything under 48 is still a go. You can buy 10 shares, you can buy 20 shares, 30 shares, doesn't really matter. As long as it's less than 88, you're good to go. Do you have an options example? I can give you guys one right now, by the way. So you can do it with an exercise with an options as well. All right, so let's say, let me prepare one for you guys, for you right now. Let's see, like 400 calls on premium is 1,000, same premium, 370 in premium. And stop losses will be set at 300. Total risk, calculate the same. It doesn't matter the strike price. So let's say like you're entering a call option by spending $370 per contract, and you're setting your stop losses at $300 per contract, and change the shares to options, number of contracts you're allowed to buy, and right amount of contracts you're allowed to buy. Now do the same. Go ahead, proceed. So you purchase the call option at $370 and you set your stop losses at $300, which is like 7% more or less from your entry. So if the contract drops to $300 from your entry, you're going to get kicked out. And what's your total risk? First, calculate that, calculate the total risk. And then from the total risk, calculate the maximum number of contracts which you can buy, that even if you get stopped out, you shouldn't lose more than 2% of your account. Go ahead. You already get some answers here. So, all right, 2-2. We'll give it some time before we reveal the answers from our end. So I hope this makes sense, by the way. This is for options. Same scenario. It's no difference. Instead of looking at the entries and stop price from the share standpoint, we're going to look at it from a premium standpoint here. 370 is your entry price. You spend $370 to enter that position. It doesn't matter what your strike price is. It doesn't matter what your expiration is. All it matters is how much you put in before buying and where's your stop losses is. That's all that matters. If you get stopped out, how much you're going to lose? What's the total risk? Let's start there. Total risk is entry price minus stop price. The entry price minus stop price, the total risk is $70. And now 2% of your account is 200. The maximum you can be buying is how much? 200 divided by 70, and it's going to give you more or less, if you round it up, it's going to give you 2. 54? How did you get 54? The answer is 2. Correct. Let me repeat it again. So for people who still don't get it, it's pretty simple. Take your entry price, the amount of money which you paid to enter that contract. Take your stop price, and in order to calculate your total risk, subtract this entry price with your stop price, and you are going to get your total risk. In this scenario, it's $70. If you're wrong, if this contract stops you out, you're going to lose $70 per contract. Now, maximum amount of contracts that you're allowed to buy, pretty simple, 2% of your account. How did you get 70? Entry price minus stop price. Entry price is 370, stop price is 300. The total risk is $70 per contract. So tolerance is pretty simple. 2% of the account is $200. Divide that value by 70. What do you get? You're going to get a fraction here. You won't be getting a whole number. You're going to be getting somewhere around 2.8. With options, you can't buy fractional options. So now, round it off to 2, because if you buy 3 contracts, you'll be risking 2.1. So something to keep in mind. 2 contracts is the maximum you can go with. It doesn't matter. Right now, you're only spending 370, right? If you're a new trader, you can just go and be like, oh, I can just buy like 5 contracts, because it's 5 contracts. If you buy, it's just somewhere around like $1,850. And I can just go ahead and buy 5 contracts. And if it stops you out, well, if you buy 5 contracts, you're going to lose somewhere around $350, which is how much percentage, by the way? 2, 3, almost 3.5% of your entire account, and which is not worth it, which is way more than your risk tolerance, and it is not worth to taking it in the first place. And this is how you size your positions properly. Yeah, 2.8, correct. So round it off and you'll get 2. Since you're trading with options, you can't buy 2.8 contracts. You can only buy either 2 or 3. If you go with 3, it's more than 2% of your risk, so you can't take that. So now you're going to go with 2 contracts on this trade. Now I can see the questions immediately pop up if you're like going with this type of scenario. If I buy 5 contracts and if this trade worked in my favor, I would have made a lot of money. But in reality, that's the unknown. When you enter the contract, you're entering with an expectation that the unknown works in your favor. But in reality, you don't know if it's going to work in your favor or not until after the fact. The only thing which you have control over is what you did right now. Knowing your stops and sizing your positions in a way that even if you're wrong, you're not losing more than 2% of your entire portfolio, even on the worst case scenario. If you're new, even if you enter a trade and you get stopped out, you enter a trade, you get stopped out multiple times. The worst day your portfolio should be having is no more than 2%. So when doing this, your entry price doesn't matter. Even if you get a terrible entry, even if you get a bad entry, as you guys call it, bad entry shouldn't drop your portfolio more than 2%. Bad entry happens. Sometimes if you're new to the markets, you're going to FOMO in sometimes. You're going to FOMO in, and sometimes it's going to happen. Even if you FOMO in, even if you lose money after FOMO, it shouldn't be more than 2% of your portfolio. That's what matters at the end of the day. Control your risk. You will see the performance follow automatically. So this is what position sizing means. So hope it was clear, by the way, when it comes to position sizing. And we do have some questions here. Let's see. Can the entry price be too high for the account balance from the beginning? Can I be again, we mentioned it before. And if you're just joining here, the entry price doesn't really matter. And all that matters is how much you're going to lose. What's the total risk? And we had this scenario before right here with this example. Entry price is at $155 with a $7,500 account, and you can still buy 45 shares on this trade. And again, you are putting in your entire portfolio with this one trade, but that doesn't really matter. Your risk is not your entire portfolio. Your risk is somewhere around $80, which is no more than like 1.5%. So max trade is the time you can trade is only 20. No, Your maximum trade is determined. We'll talk about what's the maximum amount of trade which you can buy when we go over what's the multiple positions, how to manage your multiple positions. When we are talking about the position management side, we'll go over how much amount of positions which you can open. And how do we choose the stop price? This stop price, which we have right here, it's just a hypothetical stop price, which I laid out. This session is not about how to set your entries and how to set your stop loss. It's about what to do after the fact. We're going to go over our entry price and how to set this entry and stops in the next session. But without understanding the later part, how to set your entry and stops doesn't really matter. You're still going to be losing money. If you don't have proper sizing, it doesn't matter if you have a proper entry and proper stop loss, you're still going to be yielding a net return because you'll be making money in one trade and you lose money in another trade, which is going to wipe out months and months worth of progress, just like that. We are trying to avoid that drawdown. That's the point of this entire session. And before we move on to position management, now you sized your positions properly. And take this example, you purchased 45 shares. What to do with this 45 shares? How are you going to manage this? Where are you going to sell this? Where are you going to take your profits? Where are you going to move your stop losses to? Everyone asks about, and my entry is bad. Have you ever wondered, do you even have an exit plan before entering a trade? Do you even know where you're going to take your profits? Most of you misunderstand the see profit, take profit. I hear this term been thrown around a lot of times. Here to burst your bubble, see profit, take profit doesn't work if you're not following see loss, take loss, by the way. If you're going to let your position go down like 50%, and once it comes up to like 5% or 10%, you're going to take your profits. It might work out for you on that one particular trade, but down the line, market is not about making money in one trade. It's about doing the exact same thing over and over and over for 100 times and still coming out profitable. You cannot do that by letting your portfolio, letting your position drop down to like 50 to 60% and then selling it once it comes down to like 10%. It works until it doesn't. Part of a reason why your portfolio is still negative because you're letting your loss run like 40-50% to the downside. And as soon as it turns around like $50, you see it, your position will be down like $1,000, by the way, at one day. The next day, market turns around and you make $50. And you're going to be like, gosh, I just held on to it for quite some time and I was down like $1,000. Now I just made $50. And what if it didn't come around? What if it never came back around? You just lost like almost like 60-70% of your portfolio in a single trade. There is nothing to be proud of after losing $1,000 on a trade and after making $50. That is not see profit, take profits. That's just bad habits which you're reinforcing yourself with bad back-to-back mistakes which you are doing, by the way. So you can actually, the sad part is you post these types of trades in the Discord and you're going to be like, I was down like $1,000 yesterday. I held on to it. I stuck to my plan and I just made $100. And you're going to see a bunch of people who don't know what they're talking about give you a pat in the back, negative reinforcement for the bad habit which you just did, which automatically trains you to think that it's whatever you did is okay. When in reality, all you did was digging your grave even deeper. That's all that happened down the line. You let your position go down 1,000, you need to make at least $3,000 on the trade to the upside in order to get a good risk to reward trade. But no, you cut it for $50. You keep doing this over and over. One loss you take, it wipes out weeks and weeks worth of profit. You're back to square one again or back to even losses again. So this is how traders either stay stagnant in their portfolio even after years and years worth of trading, or still have a negative P&L even if the market is going higher and higher and higher. SPY is up almost like 8% year to 8 to 9% year to date, by the way. Is your account up at least 8 to 9% year to date so far? And I'm pretty sure right now your account should be up year to date if you gambled into AMC or GME. But again, on the long run, can you sustain that performance with the same way which you're trading? That's where the position management comes into play, by the way. Now you know how to size your positions properly. Now, what to do with these positions which you just bought, that is important as well. Where are you going to sell some of these positions? Where are you going to move your stop losses to once you sell them? And how are you going to manage those runners? Are you going to sell all of them at once? Or are you going to leave some runners on the table? If you're going to leave the runners on the table, where are you going to move your stop losses to? And if you're leaving the runners on the table, where are you going to cut your runners for profits? And how are you going to manage those runners? That's what we're going to talk about next. So before we move on to that, do we have any questions so far in position sizing? Is the account balance you're available for cash? It's your total account balance, by the way. I'm not talking about the amount of, it's really the same, isn't it? If you have a $7,500 in your account, you'll be having 7,500 in your buying power. I'm talking about the total account balance. Let's say you're already in like 3 positions. Your 3 positions, whatever you're in, shouldn't, even if you get stopped out on all the 3 positions, well, you shouldn't lose more than 2% of your portfolio regardless. So we'll talk about how to manage multiple positions down the road. We're talking about the total portfolio value. Or let's say you're already in like 5 or 6 positions open. What's your account size at that time? Let's say the account size is at $5,000. 2% of that $5,000 is what we're talking about. We're not talking about how much you have in your buying power. It doesn't really matter how much you have in your buying power at the end of the day. You're going to maintain that 2% risk, not from the individual positions, but from the overall portfolio size. That's all that matters. Where does dollar cost average comes into play in that strategy? You average up on this position with this strategy. Losers average down on losers. Don't be one. If you're losing money, there's absolutely no reason to add more risk to that position by averaging up on that, averaging down on that position. Why will you do that? You're already losing money. Let's say you're going to a bank and you're depositing some money in that bank, and every month you have money put in that bank, they're taking out $500 from your account. Why will you keep adding your money into that bank over and over and over and over again? That is what you're doing with dollar cost averaging down on the losing position. But with this, we're going to average up on our position. Let's say you enter a stock price, and let's say you enter an option and it goes up like 10% from your entry, you average up. And it goes up 20%, you average up. This is how you milk your runners to a point where like you're catching every single cent of it. When you average up, you're going to move your stop losses up alongside with it. We're going to go over all these things when you're going to talk about position management, by the way. So if you have any questions, let me know. Before we go on to the position management, we play with position sizing so far. How are we determining your stop losses for stocks and options? We're going to go over it in the next session, Edward, because in this, we're not going to go over like technical analysis on how to set your stop losses and all that thing. We're only going to talk about position sizing and position management. I'm going to make an assumption here for this session that you already know how to set your stop losses. So if you don't know, that's fine. Whatever you're learning right now, it's going to give you a huge leg up once you understand how to set your stop losses. And we're going to do that in the next session, the next week. All right. So whatever we are learning right now, try to understand. And the next session, we're going to talk about how did we come up with this 550, 330 level? How did we enter in this 155 level? That part is easy. Anyone can do that, by the way. This part, not necessarily. If you want to be profitable and consistent, you need this part, not this part, by the way. You can have a shit entry and still beat the crap out of the performance of any good technical analyst out there with bad position sizing. Something to keep in mind. We'll go over it in the next session. For this session, we're going to stick with position sizing. All right. So we're going to move on to position management right now. So we've discussed about this briefly a while back. And if you open the Discord, for every 20 messages which you scroll in the Chris Saint server or any Discord which you are in, you'll see at least one message about one user crying about how their bad entry costed them like almost their 90% of their portfolio. When the hedge funds design a system is nothing but a set of rules which you as a trader need to have. And if you're working in a hedge fund, they're dealing with like multiple $1 million worth of clients' money. And they have a certain number of risk tolerance and risk checks in place. So if you're designing a system for a hedge fund, entry is the last thing they're concerned about. Entry is the last parameter. What matters more is the exits. After you enter, where are you planning on exiting your trades? That matters way more than where you entered your trade in the first place. Exit strategy is more important than the entry strategy, whatever you use. You can use VWAP to enter. You can use opening range break to enter. You can use the breakout and retest strategy for an entry. Doesn't really matter where you're going to take profits. If you don't know that, where you enter doesn't really matter. Simple as that. So now with position management, we use position sizing to calculate what's the maximum amount of shares which we can buy. Now with position management, we're going to go over what are we going to do with those shares which we just purchased? Where are we going to sell them? Where are we going to take profits? Where are we going to move our stop losses to? all that good stuff we're going to talk about in this session, in this position management guide. All right. So we're going to start with the risk. Always, always, always with the risk. So we went over this example before with an account size of 5,000. Risk tolerance is no more than 2%, which is $100. And your entry price is 55. Hypothetical entry price is 55. And hypothetical stop price is 53. And if you guys want to do this, you can, by the way. So try to calculate your position sizing on your own without looking at this. Come up with an answer. It's going to be another exercise for you. But I'm already giving you the answer here. But when you go over the exercise, we're gonna combine both of them, and you're gonna come up with your own plan. So total shares purchased is 50, and you're gonna risk like 2% on your account. So now you own 50 shares on this trade. All right, so 50 shares on this trade, and your risk is $2, which is entry price minus stop price. Now this risk is what we call as, write this down, it's gonna come in handy, the alphabet R. That's what means what's your risk. When someone asks you, what's your risk on this trade? This is what they mean. How much dollars are you risking? From a dollar standpoint, it's $100. If you're trading from shares, it's $2 from your entry. We're gonna build it up from here. This is why when anyone asks you what your stop losses are, this is where it comes in handy, because without knowing your stop loss, you can't calculate any of this. And if you're taking a trade without stop loss, how are you going to size your positions properly? If you're entering a trade without stop loss, how are you going to manage your positions properly? This is why setting your stop loss is very, very important, because it's going to show you how much contracts you can buy, how much shares you can buy. And after buying those shares, it's going to help you where you should be taking your profits on. So in this scenario, with your stop loss, your total risk is $2. And if you're trading with options, we're going to give an example for options as well down the road. But first, we're going to start with the basics. With shares, the total risk here is $2 from your entry. Your entry price is 55, your stop price is 53, and your R on this trade, the risk on this trade, is $2 from your entry. So now, let's say the next day, let's say you got this position on Friday. You entered at $55, you set your stop losses, you bought 50 shares, a perfectly sized position. The Monday, the market opens up and the stock price goes up $2. Right now, the Monday, the stock price opens at somewhere around $57. A small question for everyone here. Your entry is at $55. And when the Monday, the market opened up, it went up to $57. How much your positions will be up right now in profits? You got 50 shares with an entry price at $55. And when the market opened up, the stock opened up at $57. How much profits will you be up? How much will you be up on those positions? 100, beautiful. 100, great. 100, we're getting some answers here. So how did we get 100? For anyone who's struggling, it's pretty simple. So you got 50 shares for $2. Just multiply the $2 by the total number of shares that you purchased. You're going to get the 100 as an answer. So now let's just write it down. So if the stock goes up to like 57, you're going to be making 100. So now what's significant about this $100, by the way? Let me blow your mind real quick. So now this $100 is how much you could have lost if you would have gotten stopped out, right? So let's say the stock price on the Monday, let's just drop to like $53. How much you would have lost? You would have lost this money right here, $100. But now you just made that money in profits. You made what you could have lost if you've gotten stopped out in profits to the upside. This is when you trim half of your position. This is what we call as covering the initial risk. So when this happens, let's move on to the next slide. Right here. So when this happens, you're going to cut half of your position. Your initial sizing is 50 shares. When you see this happen, you're going to cut 25 shares at $57. And remember the initial stop price at 53? You're going to move the stop price to 55. or any recent higher lows on the other 25 shares. Let me repeat it again. When the stock price goes up from 55 to 57, you made $100. You made what you could have lost if you have gotten stopped out in profits. So now when that happens, you're going to cut half of your positions instantly and move your stop losses from $53 to your break even, your entry price. So what's the worst that can happen right now? Even if you've gotten stopped out on the other 25, after selling your 25 shares, let's say the market tried to be a big pile of junk and then completely fall back down towards this 53 again. You're not going to be losing anything. You're still going to be closing your entire trade for a small profit regardless, because you're going to get stopped out at 55 anyway. You made 50. Yes, correct. You made 0.5 hours. So this is what the importance of position management, by the way. This is the first part, covering the initial risk, protecting your capital. This is what it means. When you sell half of your position, again, there is no see profit, take profit here, by the way. You're only going to take your profits if it moves one times the risk to the upside, which is $100. If you lost 100, if you got stopped out, you lose 100. But if it moves $2 to your upside from your entry, you made your initial risk, you're going to cover some of yours in profit and move your stop losses up. What if the position never hits the stop loss or even hit that initial risk? You're going to hold on to your position until one of those happens. There is absolutely no reason to make any changes to this position now, is there? So if it never hit your profit, if it never hit 57, let's say it's just been consolidating between like 55 to 54 to 57 to 56. It's just been consolidating, but it never hit 57. But again, there is absolutely no reason to make any changes. Did it hit your stops? No. Did it hit your first target of 1 hour at 57? No. You're going to stay in that position until either one of those happens. You're only going to cover half once it hit $57, which is $2 from your entry price. How did I get this 57? Your total risk is 2. The stock should move 2 times your stop loss, your entry price to the upside. 2 times your entry price is $57. Once it moves to 52, 55 to 57, you're going to cut half. What if you're up a little bit, better than getting stopped? Not really. Nope. This is the bad habit which I was talking about. What if you're up a little bit? What do you mean up a little bit? You're risking $100 on this trade. So what? You're going to risk $100 to like take profits at 20? What type of risk to reward is that? Your risk is $100. You have to stay until you capture at least $100 to the upside on that trade. That's how it works. That is how you're going to survive in this game long run. Let's say you cut it for like $20 and it pulls back to break even and then rallies all the way towards $100. What are you going to do then? You're going to chase it right now? You already got a perfect entry according to the plan. And I wouldn't call it perfect entry. You got a perfect plan in place and you intentionally went out of the way to violate the same because you saw $20 profit. And then are you gonna chase it again as it starts working in your favor? No. And let's say even if you get stopped out at 100, and you're gonna see how it doesn't really matter how many times you get stopped out and you still come out on top down the line, by the way. So first things first, this is what we call as covering the initial risk, by the way. So now the covering the initial risk, you're going to sell half of your position and move your stop losses to break even. So even if the worst case scenario happens, you're still going to get stopped out at break even at best, rather than losing whatever money you made, whatever initial investment you put into the position. When you're in a bull market, this doesn't really matter much. But when the broader market starts turning around, and when we are in a bear market or when we are in a bear trend in the dominant indices, you're going to see, you're going to enter a position, it's going to go up, you're going to move your stop loss up, and then it just immediately turns around just like that. During those types of volatile markets, this is going to be your lifesaver. This is the template which is going to save a lot of money for you down the line. Right now, you wouldn't see this because if you just put a blindfold on and buy a stock which is in an uptrend, you're going to be making money because the broader markets are trading at all-time highs. We are in an uptrend. But when we start turning around, the discipline which you built here, it's going to carry you through that bear markets. It's going to make you survive that bear markets. At that time, your entry strategy is not going to help you. This is what's going to help you. This is what's going to keep you in the game. The entry might help you with an proper identifying proper setups, but this is what's going to keep you in the game. This is what we call, the technical term for this is covering the initial risk. Your initial risk on this was $100, right? So the stock price, it goes up 2 points and you made $100. You're going to sell half and move the stop losses to the break evens. Do we have any questions on this so far? So now the next thing is, we still have 25 shares open on this position, by the way. What to do with that other 25 shares? We just sold 25 of that, and we still have 25 more in our portfolio. What to do with them? How to manage them? That's what we're going to talk about down. When you only sell half, you only collect $50 in profit, correct? Yes, we are only collecting $50 in profit, but we are moving the stop losses on the other 25 up. The covering the initial risk is not about the profits which we are taking. It's about protecting the downside risk on our position. Even if we get stopped on the other 25 shares, we are not losing anything. We are getting stopped out at break even. So now that is what the point of covering the initial risk is. We are not even going to talk about money yet. We are still in the covering the initial risk part. We are covering the initial risk by moving the stop loss up on the 25. And even if it turns around and stops us out in the other 25, we're still going to exit the overall trade with a $50 profit, which is a 0.5-hour trade. It's not even a 1-hour trade. So it's going to stop us out for break evens more or less, rather than getting stopping us out for like entire $100 risk. So this is what covering the initial risk means. So now we still have the other 25 shares in our portfolio, right? What to do with that? How are we going to manage the same? This is what, I'm pretty sure if you're in the server for quite some time, if you're following my tab for quite some time, you might have heard me throw around this term called 1 hour, 2 hour, 3 hours. What does it actually mean? 1 hour is what we discussed before, that $57, the stock price moving 1 times your risk to the upside, which is $2 from the entry price, which is 1 hour, 1 times your risk to the upside. 2 hours means 2 times your risk to the upside, which is $4 from your entry price, $59. 3 hours is 3 times your risk to the upside, which is $6 from your entry. That is what 3 hours actually means. So which means $61 is where you will be closing majority of your positions if you entered at $55 with the stop loss at 53. Your total risk is $2. If it goes to $57, you cut half and move your stop losses to break evens or recent higher lows. And now you're going to make the second cut. You're still holding your 25 shares, right? You're going to be making the second cut on the 15 shares if it gets to $59. And you're going to either move your stop losses to this $57 mark or to the recent higher lows on the last, how many shares you're holding? Last 10 shares you're holding. And now, once the stock price hits $61 to the upside, which is $6 from your entry price, 3 times your stop losses and profits, you're going to make the last cut by leaving the last 5 shares as runners. And now, whatever you have, I'm cutting 5 here. Okay, you're going to leave the last 10 shares of the runners, or you can leave last 5 shares of the runners. You're not going to be closing the entire positions here. You never close an entire position on a trade if a stock is still looking strong. The last few runners will be left on the table, and all you're going to be doing is just keep moving the stop loss up higher and higher and higher and higher and higher. And you're going to leave those positions on the portfolio until you get stopped out. All right, so let me repeat it again. 1 hour is nothing but 1 times your stop losses in profit. Here, the total risk is 2, which means 1 hour means $2 from your entry price to the upside. 2 hours means 2 times your risk. 2 times $2 is 4. So which means $4 for your entry price to the upside. 3 hours means 3 times your risk, which means 3 times your stop losses. 3 times 2 is $6, which means $6 to your entry price, which is $61. So when the stock hits 1 hour, we immediately cut half and move our stop losses to break evens. And when the stock hits 2 hour, we're going to get rid of the other half of the position. Like we're going to get rid of like 15 more shares, whatever we have. And we're going to move our stop losses to either this 1 hour price at $57 or whatever recent higher lows which we see on the 15-minute or 30-minute time frame on the charts. And once the stock hits 3 Rs, we're going to be out from majority of our positions by leaving some shares as runners on the table. And those last runners, whatever we have, it's going to monetize our positions if the stock keeps going higher and higher and higher. Trading this way is going to remove your thoughts of like, damn, I shouldn't have sold early. I should have left some positions on the table. I sold it too early. All the thought process, whatever you have, it's going to go away because you always have some skin in the game. You're not buying 10 contracts and selling 10 contracts all at once. The point of you buying multiple contracts is it's going to give you the ability to manage your positions. So if you buy like 50 shares, it gave you the ability to sell 25 shares when it moved 1 times your stop losses to the upside. And it gave you the ability to sell another 15 shares when it moved 2 times your stop losses to the upside. And it gave you the ability to sell another 10 shares once it moved like 3 times your stop losses to the upside, and still left some runners on the table. So if it continues to keep going up, if it goes towards like 65 or 60 or 65 or 70 or 80 to the upside from wherever you sold, the last 10 shares, whatever you're holding, or last 5 shares, whatever you're holding, they're still going to keep making you the money over and over and over again, all the way to the upside, by the way. So you're not going to be sitting here and wondering, I should have held on to my initial positions, like I would have made a lot of money. No, you did make a lot of money, and you're still making money on a day-to-day basis as the stock keeps continuing in the direction of the trend. Have you ever heard this phrase, let your winners run, cut your losers early? This is what they mean by that. By let your winners run. It's not about like once like 25% to 30%. And there's a difference between being greedy and letting your winners run, by the way. Being greedy will be you holding this 50 shares at $57, not making any changes, holding the same 50 shares at $59, not making any changes, holding the same 50 shares at $61 and not making any changes. And next day, the share price drops all the way towards this 55 again and losing everything, whatever you make, not capturing a single cent. And you didn't not only just not capture a single cent from this trade, you just lost out a 3-hour profit and made it turn into a break-even trade without doing anything. Bad position management. That is what being greedy means. There is a thin line between managing your positions and being greedy. This is what you need to do to manage your positions properly. When it moves 1 times your stop loss, cut half. No questions asked. Cut half immediately. Move your stop losses to break even. If it moves 2 times your stops, cut the second half. Move your stop losses to 1 hour. If it moves 3 times your stops, cut the third half. And then leave the runners on the table by just moving your stop losses up higher and higher and higher. That's all you need to do. And now you're going to get stopped out over and over again. It's going to happen. You can't change that. You're going to get stopped out. The win rate of professional traders is 30 to 35%, more or less, 28 to 35% range. That's the win rate of the professional traders, by the way, which means for every 100 trades they take, they're going to lose on 70 trades, and they're only going to win on 30 trades. They're still profitable because of this 3 Rs right here. Every time they lose 1 hour, but every time they win, they are making 3 times their stops and profits to the upside. That is what keeping their portfolio afloat. Take the small example. Take 100 trades, and let's say like, I'm going to give you the same win rate. I'm going to give you a win rate of 30%. Every time you win, you make $90. Every time you lose $30. All right. So every time you win, you're making 3 times your stop losses and profits. Calculated. You're losing on 70 trades, which means you're losing $2,100. But you're only winning on 30 trades. But every trade you win, you're making $90, which means you're making $2,700. Even with a win rate of 30%, you're still coming out profitable with a $600. And when it comes to the markets, that's all that matters. No one cares about the win rate. If someone is bragging to you about, I have a 90% win rate, amateurs. Simple as that. No one who is experienced is going to brag about their win rate. The more you trade, the more you're going to realize this. Lesser the win rate, the average win rate is 30 to 35. That's all you need to beat the crap out of the markets. If you have a lower win rate, tighten your stop loss. You can't afford to have wider stop losses, like risking 10%, 15% of your account if you have a lower win rate. If you get the feeling that you suck at these entries and exits, well, tighten your stop loss. You're going to get stopped out like 10 times, and all you need is to win like 3 times to back in the profitable territory again. So something to keep in mind. This is the basics of position management, by the way. So we're going to go over another example, and I'm going to give you guys the exercise on the same and try to cover it up. You can lose 3 times and win once and still be even. Exactly. So now, the next position. In this, account size is 2,000. 2% per account is $40. And we already went over this before. So we're just going to go about how to manage this position. So now, total number of shares purchased is 40. And if you get stopped out, you're going to lose $40. 2% is the risk. So how are you going to manage this? What is 1R on this position? Calculate the total risk. The risk is calculated by entry price minus stop price, which is equals 1. So let's say the Monday the market opens. The stock price goes up $1 from your entry, which is stock price is trading at $11. $1 from the entry price, you captured 1R. What do? Immediately cut half of your positions and move your stop losses to either break evens or the recent higher lows. Now, let's say the stock price goes 2 times your stop losses to the upside to $12. Next cut will be made right there. And either you move your stop losses on the runners to either 11, which is 1R, or the recent higher lows. And when the price hits 3 times your stop losses to the upside, well, that is where you're going to be exiting most of your positions by leaving some runners on the table, by just moving your stop losses on over and over and over again until the dominant trend shifts. That is all you need to do. So this is the basics of position management. This is the basics of how you can have your stop losses and make your entire plan from it. Whenever I ask you guys what's your plan is, this is what I mean. What's your entry price? What's your stop price? And where you're going to take the first profits. And once you take your first profit, where you're going to move your stop losses to, where you're going to take your second profit. Once you take your second profit, where you're going to move your second stop losses to, and where you're going to close your entire trade at. And if you do get stopped, how much percentage of your account is at overall risk? Now, this is how a proper planning looks like. You need to have answer to these questions before even pressing that buy button, by the way. Something to keep in mind. I'm going to buy here. My stop losses are here. My overall risk is no more than 2%. I'll take my first profit here, second profit here, third profit here, and I'll move my stop losses to this particular standpoint. Once I cover my initial risk, and once I take my 2 hours, my stop losses will be moved here. And once I'll close my entire trade once the price hits this price point. Now, when you actually have these plan, tell me, will you be panicking? Will you be asking a random stranger what to do with your money? You guys don't realize how pathetic it is. Like when you come on, like when you guys, like not all of you, some of you are really smart here, but most of the new traders, I've done this. I've been stupid. So like, I'm just talking for myself. When I started, I come to Discord and I just ask people like, I got this option position on, what should I do with this? What should I do with my money? Should I just sell it, or should I sell it for a small loss, or should I just hold it? Why will you ask a random stranger what to do with your own money? In order to avoid all that, kindly learn this. This is how you plan your trades. This is how you size your trades. This is how you manage your trades. When you have this, you don't have to be reliant on anyone. You take the trades, you size your positions based off of your portfolio size. You manage your positions based off of your portfolio size. You don't need anyone to tell you what to do with your money. You will be in control. Depending on your portfolio size, you're going to be managing your risk accordingly. And when you do this, you're not going to be tempted by looking at the screenshots of random strangers online who post like $10,000, $20,000, $30,000. Doesn't really matter. If someone is just sharing the screenshots without telling their total risk, you don't know if they risk them almost their entire account to make the same amount of money, or if they risk like 2% to make the same amount of money. You don't know any of it. A screenshot with the profits doesn't tell you anything. The more you trade, the money means nothing. All it means is how much do you risk to make that exact same amount of money. So right now, as a beginner trader, it's very, very easy to get tempted by looking at these screenshots. All I can say is it doesn't really matter. Don't get tempted. The amount of risk which you can take, focus on that. What's your portfolio can handle. Focus on that. That's what we learned with position sizing. How are you going to manage the positions which you opened at? Focus on that. That's what we discussed about position management. So something to keep in mind. Try to make at least 3 hours in profits, 3 hours. Try to capture at least 3 hours to the upside. If you're entering at $10 with stop losses at $1, try to capture at least 3 times that in profits to the upside. Something to keep in mind. All right. So before we go to the exercises, do we have any questions? Oh, we did have a lot of questions. Let me see. Thank you. Change your account to cash accounts for unlimited day. Why do you need unlimited day trades if you're new to the market? So you don't need more than 3 day trades per week, by the way. If you're new to the markets, all you need is 3 day trades per week. Use the 3 day trades as a tool to get stopped out on swing positions. You don't need to day trade if you're new. You're not going to be profitable if you're going to day trade if you're new, by the way. There's a difference between being realistic and being optimistic. I can feed into the delusions. I go with the probabilities. 98% of the day traders fail. They fail because they just jump into day trading without understanding any of whatever we discussed about right now. Without understanding of any of this, position sizing or position management, how are you going to be profitable day trading? So if you are not using any of the margin features, I would say like cash accounts has its own advantages, but margin accounts do have your own advantages as well. It's going to force you to not overtrade. It's going to force you to sit your ass down and like don't take more than 3 day trades a week and use those day trades as a tool to get stopped out rather than forcing yourself to trade every single day. It builds discipline. And I would recommend sticking to margin account if you're new and if you're lacking discipline and lacking in the discipline part. It's going to help you restrain yourself from trading. But if you're going to use cash accounts, if you're disciplined enough, you can actually use cash accounts to just trade stocks by following the position sizing and position management. It has its own advantages, but if you're someone who lacks discipline, I would say stick to margin account and until you get the discipline in check. If you don't have discipline, cash account is just going to dig your hole even deeper, by the way, in your portfolio. Something to keep in mind. All right, so let's start with the exercise. Let's go. First things first, account size 7,500. Same scenario, which we did before, 45 shares, 48 shares, which you guys calculated before in the position sizing. Entry price 155, stop loss is 153.30, and your total risk is $1.70. The maximum number of shares which are allowed to buy is 88, but we are going with 45 shares in this scenario. So now, how are you going to manage these positions? Where will you cover your initial risk? If you did, where are you going to move your stop loss to? What's 2 hours from your entry? What's 3 hours from your entry? And give me how you manage this. Go. And pretty simple. The total risk, you got this right here, $1.70. What's the total risk? Calculated, 1.7, beautiful. And where will you cover your initial risk? What price point will you cover your initial risk? What is 2 hours from your entry? What is 3 hours from your entry? And this is what's going to tell you where will you secure your profits at, by the way. Try to answer these. It's way simpler than the position sizing thing which we did. No, that is 1 hour. That's 1 times your risk to the upside. 156.70. Yep. Robert, risk. Okay, 170. What's the place to cover the initial risk? 156.70. Beautiful. And 158. Beautiful. You guys are on the right path. And what's the 3 hours? 160.10. All right, perfect. So now you guys didn't tell me how many shares you're going to sell at each place. Like that's what I wanted. Well, and if you cover the initial risk, you got 45 shares in this scenario. How much will you sell when you cover the initial risk, and where will you move your stop loss to? And when it hits 2 hours, how much shares are you going to sell over there, and where are you going to move your stop loss to? When you hit 3 hours, how much you're going to sell, and where are you going to move your stop loss to? That matters way more than identifying 1 hour, 2 hours, and 3 hours. Go ahead. You guys gave me the answer for 1 hour, 2 hour, and 3 hours, and now try to add that to the mix. How many shares are you going to sell when it hits the point of question 2? and how many shares you're going to sell at question 3, and how many shares you're going to sell at question 4. That matters more. Try to answer it. R1 equals 2250. Oh, no answer. How do you get 2250? Oh, okay, amount of shares that you're selling. Okay, fine, got it. Sell 22 at 156.70. Okay, where are you going to move your stop losses to after you sell this? You sell 22 shares at 156.70. Where are you going to move your stop loss to? 155. For this template, 155 is fine. Okay, great. What's the next cut? So how many shares you're holding right now? Sell half at 1 hour, sell half at 2 hours, sell half at 3 hours. Let the winners run this. Okay, sell half at 1 hour, and what to do with the stop losses on the rest? Sell half at 2 hour, what to do the stop losses on the rest? Sell half at 3 hour, where's going to be your stop losses? I'm not letting you guys off the hook that easy. 2 hours, 157.23 shares. Where are you going to move your stop loss to? That's the important part. You guys are missing that one. You guys, right now, it's pretty good. You guys know where 2 hours is 157. Okay. That is not 2 hours, though. That is 1 hour. So it's pretty simple. Markina, it's pretty simple. 155. Add 1.70 to 155. That is your 1 hour. So add another 1.70 to whatever value you got from the 1 hour. That's going to be your 2 hours. For example, 155 plus 1.70 is 156.70. That is your 1 hour value. Write it down. 23 shares. Okay, so you guys are still not answering. So for example, let me give you guys an example on what I'm expecting. All right. So right now, 1 hour is 155 plus 1.70, which will be, you'll cover your initial risk at 1.70 and move your stops. By covering the initial risk means sell half and move the stops on the rest to break evens, which is your entry price, which is at 155. And now, how many shares you guys are holding? You guys currently holding 45 shares is the current position. So let's say like 24 shares you're selling right here, or 22 shares more or less. Yep, 22 shares is what you're selling right here. And now how many shares you're still holding right now at this moment? You're still holding 23 shares at the moment. So somewhere around 23 shares is still running. So now what are you going to do with the other 23 shares? So how much are you going to sell when it hits 2 hours? 2 hours is nothing but this value, 156.70, plus your initial risk, by the way, which is 1.70. That is what 2 hours actually mean. So which is 156.70 plus 1.70. You guys are nailing this part, by the way. You guys are getting this part really right. Where I'm not getting the answers at is where you're going to move your stop losses after selling this one right here. Sell 11 at 2 hour. Okay. Where are you going to move your stop loss to? Okay, Robert got an answer. 23 shares stop at 155. Okay. 15 shares stop at 156.70. 5 shares stop at 158.40. Beautiful. There you go. This is what I need. This is what I'm expecting. Good job. Like now we're getting the answers. So hope you guys understand the expectations here. It doesn't matter how much you're selling. It's all it matters is where you're going to move your stop loss to. How are you going to control your risk after you sold it? After you sold it, the amount of risk which you're exposed went lower significantly, by the way. Even if you're wrong, even if you get kicked out, you're still going to get kicked out for a nice chunk of change with a very, very less risk exposed to the broader markets. That's what matters. That's why I need to know where you're going to move your stop loss after you sell this. This is what position management means. Controlling your risk as you trim your positions to the upside. And now ask yourself, can you manage anything if you just buy one? That's the next question. If you just buy, I'm pretty sure most of you are just like, I'm just going to buy one option contract because two is too risky for me. Can you manage your positions if you just buy one of anything? One of anything means position management is off the window. You can either buy or you can either sell. It's a boom or bust cycle. Let's say like it goes up 20% and you just sell. And if it goes up like 40%, you just sell. Or if it comes down like 20%, you just sell. You can't manage it. This is why you always go with two, at least two shares. If you can buy 2 shares of a stock, it's a go. A stock is never too expensive, by the way. If you're going with a $7,500 account, and let's say like you're using a Berkshire Hathaway stock, and you can't buy, I mean, like a BRKB, which is going for like $300 and change, or let's take like HD, which is UNH, which is like a $500 stock, or let's take like Nvidia, which is a $900 stock. If you're trading with a $2,000 account, you can still buy 2 shares of Nvidia, by the way. You can still buy 2 shares of Nvidia with a total risk of 2%, which is $40. And you can still take the trade all the way to the upside. With 2 shares is all you need. You can manage the same. Absolutely phenomenal. You can't sit here and say it's like too expensive for me to trade. No, if you can buy 2 of something, it's never too expensive. It's a go. Because anything above 1 opens doors for management. Something to keep in mind. The stock is never expensive. The only thing which determines if it's expensive or not is your risk. When you calculate it with your risk, you're going to see, okay, I can't take this trade anymore because it's too risky. It's more than 2% of my risk. I'm not going to touch this. So I would recommend sticking with the hard stops until you get that 3 hours. And after you get that 3 hours, enable the trailing stops on. From 3 hours, it doesn't matter. Just enable the trailing on. And as it continues to keep pushing up, the trailing will keep pushing up alongside with it. And you can manage it accordingly above. All right. So until you get that 3 hours, manage it with the hard stops. And after the 3 hours, you can just enable the trailing stop losses on, and you don't even have to focus on it anymore. As it continues to keep pushing higher and higher, your trailing will follow the stock price, and you're just going to manage it accordingly. All right. So now, just so you know, it's not all talk, by the way. Following the same concept, this used to be when this account was given to me, this account used to be a $3,400 account. This was a small account which we started trading last November, by the way. Every single trade is logged in the server. And every single trade has been followed by the same concept, what I just mentioned to you guys before. This account has never touched options. Following the 2% rule, a single trade, whichever I took, never lost more than 2%. The worst day this portfolio had was 1.8%, by the way. This is the performance from January to right now. This portfolio is beating the crap out of the markets, and it's up 40%. And if you believe risking 2% won't yield you a profitable returns down the road, well, here's an example proving you wrong. And every single trade which has been taken in this portfolio has been logged. Every single entries and exits has been logged. Every single initial cut, every single thing has been logged. So try to follow this. Try to have the discipline to follow the strategies, whatever you learned. So are you adding? Nope. The last time I added money on this was like during November of 2023, $3,400. That's where it started. Why do you not? Because this account can't afford the risk of options. Simple. We just went over it. 2% of this account is nothing but $100. And I cannot afford to buy 2 contracts with $100 risk. It's very easy for me to get stopped out, and it's not worth it. So until I get this account to 7,500, I'm not going to be touching options. And why would I need options when I'm outperforming the markets by almost like 30 to 40% year-to-date basis? Doesn't make sense to me. So once 7,500 is hit, then I would consider strategies like credit spreads or debit spreads, and then we can slowly chime into the options, other part of the options. So now, if you're trading with the smaller accounts, if you're trading with the $1,000 accounts, it doesn't really matter. If you're trading with the $2,000 account, doesn't really matter. If you're trading with a $750 account, doesn't really matter. Focus on the percentage. That's all that matters at the end of the day. The dollar doesn't matter. Dollar is subjective. You can make 2% on a day, and that's going to be a phenomenal day. And the problem with the new traders is they will be having a great day. They will be making like 4% in a single day, and they wouldn't be proud of themselves. And they will be telling them something, I just made like $20. So It's not a big deal. Like, what do you mean it's not a big deal? You just made like 4% of your entire account in a single day, and that is a huge deal. There are certain things which you need to be proud of yourself. Again, you should look at your portfolio from the eyes of your portfolio, not from the eyes of what you value that money as. $20 might not seem like a big deal to you, but it's a huge deal to that portfolio which you're trading with. So give yourself the credit where the credit is due. You don't have to be too hard on yourself, even after making 4% of the money. And let's say like when the markets are down like 1% and your portfolio is only down 0.5% because you followed the proper position sizing and position management rules. When that's the case, well, you outperform the markets regardless. The SPY is down 1% when your account is only down like 0.5%. You did a great job in position management, by the way, position sizing and position management. If you want to outperform the markets, this is how you do it. Working strategies are slow and boring, by the way. Any working strategies which you pick are slow and boring. I cannot sit here and bullshit you into making you believe that if you join me, I'm going to convert your $10,000 account to a $100,000 account. What? You're not even making money. How are you going to expect to believe my bullshit that I'm going to promise that you're going to be making like almost like 1,000% year to date? And this might seem slow to you. Imagine you trading with a $250,000 account, a $500,000 account. 40% of $500,000 is how much? Now it's not so slow now, is it? Think about it. It's not. You made 40%. This is not slow, by the way. 40% year to date, when the year is not even done, we just still have 6 more months to go. If you're trading with a $60,000, $70,000 account, what is 40% of 60,000? 10% is 6,000, by the way. We are talking about somewhere around 24 grand. Not so small now, is it? That money came by not by YOLOing your entire account on options. It came by with following the simple 2% risk. 39, you are looking at this right now, 1,480, and considering it slow. I am looking at this 39.18 and telling you, if this is a $50,000 account, 40% of 50,000 is 20 Gs, by the way, 20 grand. Not so small now, is it? Something to keep in mind. Look at the percentage, not the dollar. That's what's going to let you trade any sized accounts, regardless of the dollar amount. Using these position sizing strategies, you can trade any sized account, regardless of whatever account size you're handling. It can be a $5,000 account. It can be a $10,000 account. It can be a $50,000 account, $40,000 account, something to keep in mind. All right. So try not to touch options with the smaller accounts, something to keep in mind until you get to 7,500. And then you can easily, I'm telling you, follow this strategy, come back at the year end and compare your portfolio to someone who's trading options with the same sized account. You will see how much of an ass kicking you gave to them when it comes to the performance. So option traders make money in one trade, and then the next trade, one trade doesn't go well in their favor, it takes away weeks worth of performance, and they're going to start over again. Whereas you, even if like you see the drawdowns here, you see like we did actually lose money. It's not like something which keeps on going up. There were trades where like we got stopped out, but again, all it took back was few runners to take us back all the way towards the new highs. Pull back, new highs, pull back, new highs. That's how a healthy portfolio looks like. Something to keep in mind. All right. So thank you for this information. I didn't know this until now. I have blown so far about little knowledge, and I'll restart tomorrow what I learned today. Good job. Trust me, if I trade the same calls in the option watch lessons and paper trading account, you'll see it works. Exactly. If you know how to manage your positions properly and size your positions properly, I don't care if you trade options. I just worry if you guys don't know how to size your positions. Now that you know, you can do it properly. So this live is about buying and selling stocks. No, you can do the exact same thing regardless of the instruments which you buy, by the way. We went over some examples on options as well. So once the recording is out, you will see the examples which was given for options as well. Position sizing and position management isn't contained to buying stocks, by the way. It goes off regardless of instruments which you use. I use the same instruments to trade futures, same risk level to trade futures, same risk level to trade stocks, same risk level to trade options. 2% is etched in the stone. It's etched in the stone. I'm not going to be changing that. So the instruments which I trade at the end of the day doesn't really matter. So with that being said, hope you guys found this helpful. So if you guys want to join the community and if you guys want to be a part of this journey, so we are trying to grow this as much as possible. We've been doing this since November. And if you are a part of my server since November, you have been a part of this entire move to the upside. If you want to join, feel free to check out the Patreon. The link is down below in the description. And if you want more in-depth analysis, feel free to check out the mentorship programs as well. I will leave the links to all of it in the description when the YouTube video is out on this page. So if you guys want more details about these two, feel free to reach out, and the links will be down below in the description of the YouTube channel. Thank you so much for tuning in. And if you guys have any questions right now, I'm just going to give you guys a chance to ask it right away. And if not, thank you so much for tuning in, everyone. Really appreciate it. And we do have some questions coming. So I'm just going to give you guys a chance to unmute yourself. So just give me a minute. All right. So, yeah, you guys can unmute yourself right now and ask the questions right away. Go ahead. Anita, it's all yours. You can unmute right now, by the way. Go ahead. Georgia. All right.
Hey, quick question.
Go ahead.
So, you have coaching as well as or we could do the mentoring.
Yeah, anything.
Those are two different options.
Yeah, but the mentoring is pretty new. We just added it a while back. So we are trading with a $1,200 or $1,000 accounts with the mentoring. We just started it like a few weeks back. So if you're joining the mentorship programs, you get a free one-on-ones, and you're going to get the priority support on everything, whatever we do on a day-to-day basis. And we also trading live on a $1,000 account by following the exact same rules, whatever we learned so far. And you're going to be joining with me on the trades, and I'm going to walk you through every single positions, whatever you opened and whatever we closed. So that is for mentorships, and it does come with additional perks of free one-on-ones and all the other good stuffs. So feel free to check out if you're interested in it. I kept the price lower compared to the competitors for a reason to make it affordable. But if you're if you want the Patreon, you can also check out the Patreon as well. And I'll post a link for both of it so you can check it out and join whichever you find it comfortable. One is the lifetime fee. The other one is the monthly fee sort of scenario. I just shared the link for both of it in the Zoom chat. Check it out.
Okay, thank you.
All right. Yep. So thank you so much for tuning in, everyone. I really appreciate it. And if you guys have any questions, feel free to reach out on the Discord. I'm more than happy to help you guys out. And
one question.
Yep, go ahead, man.
Oh, hey, one question. If my account is bigger than, like, I want to really start over again with 5,000, but I'm already invested in more, positions without all this. So let's say it's double. Let's say 10,000. Will you think it's wise to mentally just keep the $5,000 buying power and retain the rest, or should I kind of like, I guess, liquidate and lower it to 5,000 to start all over again?
Okay, let me ask you a personal question. If you're comfortable, you can answer.
Absolutely.
Were you profitable trading with a larger sized account, or were you losing money?
I started losing money because of my schedule. My work schedule wouldn't allow me to be on the phone as before. So obviously I didn't know anything about this, and I started losing money just because I couldn't manage it.
Okay.
But before, obviously, I was able to get to that point. Just pure dumb luck, I'll be honest with you.
Okay.
And I do have a couple of NVIDIAs and a couple other that are doing well. So. But I really want to start all over again with this mentality.
Okay,
so I want to know what would be the best. Yes, thank you.
I would recommend starting with a $5,000 account or $2,000 account or $2,500 if you're using margin. Stick to margin account. Sure. Don't do cash account.
Okay.
Stick to swing trading. Don't do day trade. All right. So in the next session, I want you to reach out to me in the server, and I do and join the live streams if every morning if you can, and if you can't because of the work, and just reach out to me whenever. I will get back to you shortly, and I'll sort out the Discord and all the stuff so that like you can just enter the trade, set your stop loss, size your positions properly with whatever you learned, and just walk away. And what's the worst thing that can happen if you trade this way, by the way? Let's say
my risk tolerance.
There you go. The maximum you can lose is 1% or 1.5% or 2% of your account, even if you get stopped out. That's the worst.
So in this scenario, just keep my account that I have right now, but just use the 5,000 buying power, or just get another account.
Or start with the $5,000, keep the $5,000, or if you're planning on tracking your performance from here on using this strategy.
Yes, sir. That's my plan.
Yeah, if you already lost money with the previous account.
Yes, sir.
Remove this account and open a new brokerage and put this $5,000 in there, so you can actually track your performance in real time on what's going on from the day you started trading with the strategy. And back at it by the end of this year, you're going to be surprised how much you improved from what you were doing before, without even learning about these technical analysis or whatever it is. Like I'm telling you, I'm just going to be honest with you.
Yes, sir.
There was this and it's not my opinion, it's a back test which was done with a bunch of traders.
Yes,
there was like one trader who doesn't follow any technical analysis, who just buys and sells. So his probability was either 50% winning or 50% losing. It's just a coin flip. He just enters at random areas.
Right.
But that trader had proper position sizing on it. So he's going to enter, he's not risking more than 1% of his account in a trade. So if he wins, he makes 3%. If he loses, he loses 1%. All right, that's what he's doing.
Wow.
The next
trader won.
Yep, the next trader is following the technical analysis, and he's having a proper entries and exits, and he's having a great win rate, and he's just like buying and selling at buying and selling using the technical analysis, but he doesn't have a position sizing left.
Yes.
But at the end of like 1 year's worth of performance, the trader with a 50-50 win rate, the 50-50 coin flip sort of entries, outperformed the trader with a bad position sizing. And if you think about it, it's not because of the technical analysis entries or bad exits you're losing money. It's because of the underlying fundamentally failing of not managing the sizing, not managing the positions, whatever you're holding. So you're pretty sure you might have heard this risk management, right? The risk management doesn't exist. How can a risk management exist without your position sizing and position management? How can you manage the risk without these two?
Yes.
So that's what's important about this session, by the way. So you can't find these sessions on any of these YouTube videos because most of these YouTubers don't know what they're talking about. And that's the sad part when it comes to these FinWit kind of YouTube space. They make more money selling courses rather than making money actually trading. If you don't know this, it's going to be very difficult to be consistently profitable down the line. Consistency comes from whatever you learn today. Probably
thank you so much for that.
Come from the technical analysis which you learned. And the next week, we're going to talk about, we gave an hypothetical entries and stop losses in this case. But the next week, we're going to go over how to set that entry, how to set that stop losses. We're going to talk in detail about that. I don't want to talk about that first, because if I just go over that without this, it's not going to help anyone in any way, shape, or form. It's just going to be just another stream where another trader talks about his entry strategies. That's what it's going to be.
Gotcha.
So I would be just another trader for next week. For this week, we're going to just go in depth, and I'll post a recording of this video on my YouTube, and I'll share the link.
Right.
Go ahead and check it out. And if you have any struggles, go back and look at it again, and it's going to help you out big time. And I want you to reach out in the Discord to me, and I'll take care of you with the server.
All right. I appreciate it, Mario. Thank you.
All right, everyone. How do we find the live streams in the morning? The live streams, the link will be, let me share just a minute. Hold on. Okay, so can you see my Discord screen right here? The links to the live streams, if you go under the Pro Investors tab, you should see something, my tab right here. The links every morning will be posted in this tab. Keep an eye out. So before the market open, you will see all the updates on like the swing trading positions, if I take anything or what I'm looking for in QQQ. And every morning in the live, we will trade NQ. If you trade NASDAQ futures, we'll trade that live. And if you want to trade QQQ, we trade that live in that live stream. Every swing trading positions, which we open on the portfolio, which I just showed you a while back. Where is it? Hold on, if I go up, there you go. This account, the performance, this is what we're talking about. This account, whatever positions which we open or close, will be taken in the live streams every day in the morning. So if you can't attend the live streams, it will be logged in my server right here under the small accounts. So whatever positions we take, we're ready to trim 2 hours, trim 1 hour, like whatever you learned so far right now, you should understand whatever any of these means. When we enter, consider the second trim 175. Hood is looking constructive, and I'm opening a new position right here, and every detail will be logged right here in my server as well. So if you can't join the live streams, I would try to record every single one of them. So you can just go over it, and the links will be posted right here under the Mario tab. So feel free to check, keep an eye out for it every morning at around 9 o'clock to 9:15. That's where you'll find me. All right. So that being said, feel free to reach out if you have any questions as usual. Thank you so much for tuning in. I really appreciate it. And thank you for giving your time and listening to this almost like 1.5 hour session. And I'll post the recording in the tab in the learning resources section. Have a great rest of the day, everyone. Take care. Bye-bye. Peace.
Mario? Oh, Mario?
What's up? Go ahead.
I have a quick question. Regarding the payments, I just checked the website. Do you guys have installment, or it has to be one payment?
Can you repeat it again?
Like with the payments, like to join your mentorship, does it have to, like, do you guys take installment, or it has to be one full payment?
But for now, it's just one payment all at once. I don't know if Patreon allows like paying on a month-to-month basis. And I will see if I can create my own website to offer that service, by the way. But right now, I believe it's going to be on a one-time basis. Like you just got to pay all at once. I don't know if Patreon is offering monthly payments through the cards. I'm not quite sure.
Yeah, with this stuff, because like I'm a monthly payment every month, they just withdraw it in my account. So yeah.
So I'll check it out and let you know.
It's a lot, eh? So just making one payment, the 4,000 some hundred, because I just checked the website.
So right now, I don't think this Patreon allows to do the monthly payments, but you can give it a try if something new shows up, and I will try to do a cheaper version of the same. I believe 3,500 was already cheaper because it's like complete lifetime, and you're getting the one-on-ones, which cost like $125 an hour for me to do the normal one-on-ones with regular traders, and you get the live streams every morning, and for the entire lifetime, you're glued to me sort of scenario. So I would see if we can get the price lower, but for now, it's already lower to a point, and if some offer shows up, I will work with you down the line, all right?
Okay, thank you so much.
All right, have a good one. Take care, everyone. Yep.